Ladies and gentlemen, welcome back to Perception Paradox. My name is Jivila and we are back for another treat. Today it's all about the fundraising and founders' journey and what's happening in the market and what are the alternative ways for founders to raise when they are in the early stage. And my guest is Jeffrey Fidelman, who is a Harvard alumni, also used to work at Morgan Stanley, and right now the driving force behind Fidelman & Co., an investment bank, I would say, built for disruptors. So we sit down with him and we cover more about the current investment landscape, how differently he is approaching this whole fundraising process, how together with his firm they're working with founders, and how can you raise successfully, I would say. So join us for this episode and learn that it can be done actually with listening, empathy, and data. Enjoy. Real people, real stories, and real challenges that break the status quo. I'm your host, Jivila, and welcome to Perception Paradox. Ladies and gentlemen, welcome back to Perception Paradox. This is Jivila, and today I do have with me Jeffrey Fidelman, who is joining us today together to dive into the fundraising topics, the startup world, because he's been around for a while. And Jeffrey, it's so great to have you here today with us.
Thank you for having me. Yes, thank you for having me. It's a pleasure to be here.
That's really, really great to have you here. And we were already in the behind the scenes, started jumping straight into the conversation. But I think sometimes it's so nice to start with a bit of a background story, because your journey really shorts out from traditional finance, right, at Morgan Stanley, to building an investment bank, which is specifically for startups. And it's kind of a compelling narrative, I would say. So would you bring us back? How did that evolve? And how did you actually launch such a unique investment bank?
Sure. If you had asked me about 10 years ago, I would have told you I have a very eclectic story, but for better or for worse, fast forward a decade, it actually seems a little bit more standard than anything else. I spent the better part of a decade in banking. Half of that was at Morgan Stanley, and the other half was at HSBC. And while there, I was asked to join a family office to help them run a venture fund. The focus from the venture fund was on early stage and tech-enabled investments, where we would effectively anchor a seed or pre-seed round, and then help the company syndicate the rest of the capital. And what I recognized over my time there in deploying that first fund was that founders are really, really good, ideally, at running their businesses and growing their businesses. What they're not really good at is all of these third-party, third arm's length removed items, such as building a deck, building a financial model, getting all that stuff designed, creating the narrative that investors want to hear as opposed to customers, right? It's the difference between pitching the value of the business to an investor that is looking for a liquidity event versus pitching the value of your features to a potential client to make sure that they're getting their money's worth out of subscribing or out of paying for services. So in having that kind of hypothesis, when I left the venture firm, we, now hindsight being 2020, had the idea to start an investment bank where we would help businesses prepare for their fundraisers, providing advisory on decks, models, valuation, capital structure, design. We'd always aim to keep all of that in-house because, frankly, if we were farming it out, then that's no different than what a founder or somebody at the company could do themselves. And on the other side, we more recently, over the course of 10 years, launched something that we call Fundraise as a Service. And I think that is probably what is most unique about us and our firm is our approach to how we help our clients raise capital. Traditional investment banking is all about a network, how many contacts do I have on my phone, and how many offices can I walk my clients into, where that really doesn't work in venture by design. Venture investors don't want to get deals through brokers, and there's a lot of friction when that occurs behind paywalls or gaps and incentives as well. If a broker, despite being paid for a company, really is relying on the relationships with an investor, there's a misalignment of incentive. Company A, John Smith the investor. Company B, John Smith the investor. Company C, John Smith the investor. In all cases, the company is paying the broker, but in all cases, the broker's most important relationship is with John Smith and not his or her client. I can give you a whole TED talk on the misalignment there, but that's kind of the main core points of why we thought we want to help companies raise capital, but we didn't want to do it in the same traditional way that does make sense in middle market and upper market and in places where I used to work, like Morgan Stanley. Fundraise as a service is effectively outsourced investment relations. We have the infrastructure and drop it into our clients. It's our database that we've constructed over time. It is our analyst that will then call on behalf of the company to investors. So Alex is calling from ABC Company, or Alex is emailing from abc.com. And from the investor's perspective, it's the company that's reaching out to them directly. And all of a sudden, the dynamic begins to change because we're not pitching the business. We are not meant to pitch the business. And it's all about getting the founder in front of the investor, which should really be what the founder is working on within their firm anyway. Whether it's the founder sitting on PitchBook, which is insanely expensive, and then picking up the phone and cold calling, or more likely hiring a junior person to do that for him or her. That's where kind of the value add comes in from the services that we offer. And we really found a niche in doing that. And we have helped, at this point, hundreds of companies put together their investment relations team or infrastructure and successfully get them in front of investors.
Okay, and how do investors actually react, or how did the reaction has changed, right? Because it's also challenging a bit and changing the narrative in a very traditional market.
Yes. So interestingly enough, a lot of potential clients ask us the same question: are you lying? Are you purposely putting on a mask and anything like that? And the reality is not, right? What our analysts do is manually research investors. They personalize every single outreach. So it's not 1,000 emails a day or 1,000 emails a week. And that really doesn't work in fundraising for early stage companies. You have to be targeted, and there has to be a reason for why you're reaching out. So it's not, I have a fintech company and I'm calling Mary Sue, the fintech investor, saying, hey, we're a fintech company or fintech investor, we should meet. Right? There's a lot more personalization around it in terms of criteria, fundamentals, adjacent investments that they might have in their portfolio or otherwise. So just from the get-go, there's a large personalization in that outreach. And from initial contact, the analyst is really a member of the team of the company. So again, it's not Alex from Fidelman and Co., it's Alex from ABC Company that's calling. And what we found to be most interesting is that, yes, of course, we don't work for free. There's a monthly retainer. There's an advisory fee as well that we charge on these things. And in all cases, it is very transparent around the fees and advisory fees. And in all cases, investors do end up, quote unquote, finding out. And what has been interesting is that it's been so well received. Number one is the outreach in general. Most people don't call anymore. And we get people telling us all the time, like, oh my God, you actually picked up the phone to call us to schedule an appointment, which is amazing. And we've actually ended up getting a number of clients of venture capital firms that have learned about our service through their investments that they've made because of our outreach.
Okay.
So it's been well received, to put plainly.
Okay, good. And are you operating only in the US market or globally?
So on average, we see about 80 to 100 engagements annually. I would say that 85% of them are North American, mostly US based. But we do work with a number of companies in mostly Western Europe, Middle East. We have some in APAC region. In Singapore right now, we're working with a company that is building electric boats. But I would put most of them in US or Canada, and then with maybe 20% in Europe and Middle East.
Cool. That's pretty cool to see and hear the growth and such a different perspective. But look, Jeffrey, you've been for quite a while in this whole industry and market, and we've just were touching a little bit about this whole change and different stages of a startup ecosystem. Can you share with the audience the 2 fundamental shifts you have observed over the time right now happening in the market?
Sure, sure. And this is what we were talking
Yeah,
about earlier.
exactly.
I'll start with the end and then I'll reiterate again, but I'm really excited at what is to come. And depending on whether or not it's dated, we're recording this in April 25, somewhere mid-April, and at least the US stock market, because of announcements of tariffs and a number of other reasons, has dropped significantly in the past couple of weeks. And many have compared this to recessions or other recessions that we've had in the past. And what comes to mind when I think about that, and what I was saying earlier to you, is that that is what excites me about both mid and long term. If we take a look at other points in time that similar effects has happened, both economically and geopolitically, we look back at even recent times, 2001, right? We had kind of internet bubble blowing up, and you had kind of the strongest survive and coming out and starting to build a base of the internet progressing forward into the 2000s. We had 2008. All of that kind of fell apart. 2006, 2008, the recession happened. And you had a number of social media sites get launched into that. Facebook, Twitter, and now X, and a number of others starting to grow. And you had kind of social media innovation, so to speak, and happening. Then you go through mid-2000s, 2015-ish, plus or minus, and you had both blockchains start to gain ground, or at least gain a little bit more popular momentum and being talked about, whether it's crypto or otherwise. And also things like like Uber, Lyft, Get, all the other ride sharing capabilities. So now you had this idea of distributed work because the internet was more proliferated, not to mention iPhones, Android phones, also kind of having more of a computer in your pocket. Then you fast forward 2019, 2020 during COVID, and you had remote work absolutely explode. So the idea of attracting global workforce and being able to effectively work with one another became a necessity more than a reality because of what was happening in the world. And at each of those times, if we just look back on recent memory, you had everything being built off of the fundamental proliferation of internet. And now we're kind of at a point where if the same cycle repeats itself, or spiral repeats itself, better put, we have a pending cycle of innovation that is going to happen, and now we have AI. And AI, in my opinion, or the development of these chatbots or AI bots or all of these different platforms that are getting built on top of it, is as fundamentally pivotal as the internet. And I can say from personal experience and a number of stories I've read and a number of clients that we've spoken to, and friends that I've spoken to, that they've been able to not only augment a lot of their workflow and content, but they've been able to build MVPs and apps within days for, I don't know, less than hundreds of dollars. Where in other circumstances, 5 years ago, even 3 years ago, the same exact MVP or product would have been at least thousands, if not tens of thousands of dollars, and at least several months, if not several quarters. So what we have kind of going into, and I know as a short question, I'm giving you more of a history lesson here than anything else, but I'll say again that I'm really excited because you have the ability of innovation to happen faster now. And you're giving tools to individuals who may have had ideas prior that could not ever do anything with those ideas because the tool sets didn't exist. They didn't have bandwidth. They didn't have capital to invest in it. They didn't have the network to reach out to and get a co-founder who's technical. Now, anyone can build an MVP with very, very little knowledge of programming or development. And that's only going to progress. So thinking about everyone that has an idea, everyone who wants to launch a business, everyone who wants to do kind of something themselves, the opportunity has never been greater, and the barrier to entry has never been lower for someone to start their own business.
Yeah, that's super, super true. Like to build an app now, I don't know, we can take as an example Lovable. It takes no time. It
Yeah.
says in the last 2 years, it was an insane development of a no-code tools. So I totally with you on this part, but then the question is, okay, if anyone can build, everyone wants to be a founder now. We also, at least in Europe, we do have this huge trend that everyone either lifestyle business founder or a startup founder and become a unicorn. But talking about that, how did the investors landscape change, right? We did have a very huge peak, money flowing to the left, to the right after COVID. And during COVID, have you noticed any shifts right now with all the uncertainties when it comes to economics and politics as well?
Yeah, yes, in both good and bad. And maybe good and bad is not necessarily the way to categorize it, but as one engineer once told me, it's called plus delta. And I think that's a more benign way of positioning it. On one hand, you had a lot of money flow into funds in 2019, 2020, and partially into 2021. And what a lot of people maybe don't recognize or are beginning to recognize is that funds typically have a certain window that they must deploy that capital in, whatever commitments that they had. So now, and that number is usually about 5 years. So now that we're in 2025, going into 2026, all of those funds that have raised capital, or a majority of them, or many of them that had that deployment window set, will need to deploy that capital. And when you look at the past couple of years, they have not been deploying capital. And the stock market, again, barring, let's say, this past month, the stock market has performed very, very well for LPs. So on the plus side, you have a lot of dry powder, meaning available capital inside of funds, inside of private equity firms, inside of IPO companies that are trying to go public. And you have a lot of those same investors that have committed capital into those private funds that have not been getting deployed, have been earning 20, 30% in some cases in the stock market without really much effort. So there's a huge amount of pressure on GPs to deploy that capital. There's a huge amount of pressure on private equity firms to go through liquidity events because their LPs have been sitting on marked up investments for much longer than they initially have anticipated. And what all of that is to say is that there is pressure to deploy capital, meaning that these people make money by investing money, not by sitting on money. Now, the delta side of it is maybe more around recent microeconomics in what's happening both in the market and the analysis of what venture funds have returned on a vintage basis over the past couple of years, which has been declining. And it's been declining, in my opinion, this is, every other person has a different opinion on this. You ask 12 people, you get 12 different opinions, but it's really around markdown investments, lack of capital flowing into the market, and a number of fundamentals, in my opinion, from the investor side. And I think that what you just said, everybody in Europe wants to either have a lifestyle business or be a unicorn founder. I think here, or maybe on the coasts or one coast or the other, you have a lot of people that want to be venture capital investors, that want to be VCs, but end up in that position without ever having started a company, operated a company, worked for a startup. And I can't tell you how many times that we've had clients talk to venture investors where those investors absolutely tear the founders apart. And I'll listen and I'll get feedback from our clients, and the things that they're responding to, it makes it very clear that that person has never had an operating role. And I've started joking with my team internally to call that out, and then afterwards looked at the LinkedIn profile and see a profile of somebody who has worked in government for 2 or 3 years as an intern and then gotten a job as a VC, who's went through great Ivy League schools and MBAs and PhDs and then made it to a VC, and all of these different things. But more and more rare, we have operators sitting in that role. And what that means to me is that, and this is, again, I'm not speaking in absolutes, and what it means to me is that there's less of a multiplier effect on venture capital investment. Meaning, if I know what I'm doing and I'm looking at this investment just based on a piece of paper, I'm unlikely going to help beyond giving you money, which is fine, I suppose. But I think especially in the field that we work in, specifically in early stage, specifically in startup, it's really important to those startups not only to receive the money from the VC investor, but also receive some sort of guidance or network effect or bump. And it's in everyone's best interest, by the way. If I'm an investor and I help my company succeed, then they're just going to raise more capital and mark me up. And I think the fundamental nature of like what this needs to look like A, B, C, D, E, F, G, or however you want to see how many rounds are being invested in, I think people are starting to get a bit lost in, let's just get to the next round, as opposed to, well, we're doing this for a certain goal, IPO, liquidity events, M&A, whatever the case may be.
For sure. I
So
can
I
hear
think the
you.
environment is slow. I think based on what I said before, that it is a great time to start thinking about or start working on launching a business. But if it is capital that you seek, it's a long road to actually have cash in the bank from raising an investment round.
I find it also important for every founder actually to answer why are you building, what are you building, and what kind of way are you choosing to go? Because each way, from bootstrapping to fundraising, and requires different strategies as well. And but talking about fundraising, that's why we're here today. I've also spotted your latest LinkedIn post that you reshared from your company, right? About kind of small in investment rules, and what got struck for me that you were referring to that structured outreach are more valuable now than warm intros, that capital efficiency is more important than vision decks, and data backed stories are the key to go rather than the buzzwords. I'm very curious to hear your approach, and especially when it comes to network and outreach versus interest. Do you have some cases maybe to share? Why do you find it more perhaps valuable or working more in the current landscape?
Sure. So I'll share this anecdote, and I think it resonates, and my team has probably heard me say this a few times already. When I started at Morgan Stanley, we had like an onboarding, and there was a whole training class. We went to this corporate center up in Purchase, New York, and we were going through a big class. I mean, I don't remember how many people there were, but it's all like initial people starting to work there. And at the time, I suppose for whatever reason, the CEO of Morgan Stanley, Jim Gorman, was there. He walks in and he addresses the room. And he asks everybody to pull out their cell phones and say, if I asked you to have a 10-minute conversation with every single person in your phone book, how long would that take you to do? Some people are away on vacation. Some people are sick and they call you back. If they don't call you back after 3 or 4 weeks, they're not going to call you back. But if I say 3 or 4 weeks, a month, to go through every single person, have a 10-minute conversation in your phone book, is that reasonable? Yes. So if you're going to rely on your network, what are you going to do after a month? Maybe each person introduces you to one, and that's also a highly unlikely person. Now you're 2 months into it at most. Then what? And the idea of relying on network that idea of not relying on network has always stuck with me through my entire career, and more so why the impetus of launching Fundraise as a service was the way that we did it, where we're not relying on our network at all. We are relying on data. We're relying on our analysts reaching out to those investors, understanding their criteria, their thesis, their check sizes, those investors speaking with our clients, get additional feedback on how those conversations went, what those interests were, what their diligence points were, and constantly update our own internal database so that now we know who to reach out to and why we're reaching out to them. And the fundamental point that is really important to understand is that investors are working, right? Like, I am working in this business. Most people, hopefully, that are listening to this are working in some sort of business, doing whatever they're doing, manufacturing pencils, cups, accountants, whatever the case may be, they're working. Investors are working, whether it is an angel investor, a family office, or someone sitting at a venture capital fund. Their job is to deploy capital. Because only by deploying that capital and that money making money do they make money. If they're just sitting there having calls, saying no to everyone, if they're sitting not deploying capital, that is not their job. So the reason that I bring that up is network, not to rely on network, and remember who you're calling, because you are calling people that want to be called, that are actively originating investments that only make money by deploying capital. So when we talk about warm versus structured data and approach, look, at the end of the day, I'm never going to be the one to say that warm intros are less good than a cold call. Yes, of course, a warm introduction will always be better than a cold call. But I think that there's so much emphasis put on this that it's unnecessary. There's so many VCs out there. There's so much money out there, to my earlier point, that they're looking to originate business. They're looking to get good companies sent to them. so that they can do their diligence and possibly say yes for an investment. We share our deal flow with investors for free, first of all, and on a direct basis. And I cannot tell you how many times we have one of my associates has a conversation with a venture investor that at the end, the investor says, do you charge for your deal book? Do I have to pay your origination fee? And it's laughable. Because what that means to me is that either A, the venture investor doesn't have a good way of screening investments, or they're not getting enough deal flow. And if they're not getting enough deal flow, that is not their fault. That's the fault of every single company that's out there looking for capital, simply not picking up the phone and calling that person.
Makes sense. And how would you say to someone, for example, an investor stating that if founder cannot find him or reach him for a fundraising, then it means that he is not bold enough to take the company to the unicorn status?
I agree. I absolutely agree. No one is ever going to give you anything unless you ask. I mean, I grew up that way, I suppose, and I see it all the time. I have kids and I almost test that theory on them as well. And it's just like, look, at the end of the day, if you don't ask, then don't be upset with that investor never finding you or giving you anything. In fact, I'll take it one step further. And I found myself on every client onboarding call, at one point in time prior to their first investor call, will remind them to ask for money. And it sounds so silly, but I'll tell you, like we had a client once where I was debriefing with them and my team, the client and my team after their first investor call. And something didn't make sense to me that they said, and I asked, did you ask for money on the call? And without exaggeration, Zivi, like my client, red in the face, hands in the air, screaming at me, saying, Jeff, why didn't you tell me to ask for money on these investor calls?
No way.
Yeah. And you know, I was taken aback, as you can imagine. But I think it's a simple matter. And I think a lot of founders run into this as well, is that they are afraid to ask. Maybe they get to that point, maybe they don't get to that point. And then there's something inside of them of saying like, oh, I don't want to ask for money. I don't want to ask for money. But that is what the call is about. The venture investor you're speaking to knows that they're speaking to you because you're looking for money. They're not looking for more friends, most likely. So,
Perhaps no.
So don't be afraid to ask. You know, asking is just step one. Then you have to actually convince the person to get it. But asking is step one. So to your point, like, if an investor says, if you don't have the chops to reach out to me or find me or get in touch with me, then I don't want to invest in you.
Yeah, that's wild. It's one of my biggest learnings during life. If you don't ask, you don't get. I think I've got it from one of my good leaders. I used to work in one company. If you don't ask, you don't get it. That's it. You have to ask.
Yeah, exactly. That's just step one.
Yeah. Are there any other critical mistakes or failures you notice when you work with companies who are fundraising, with the founders?
No, you know, critical mistakes. I think we see a lot of common denominators, and perhaps many of the things that we say in our onboarding at this point is being said because of our learnings from what clients have done in the past. So I don't want to necessarily say critical mistakes. So yes, a critical mistake would be not being personable in your follow-ups. So another story is that client had spoken to maybe 24 investors over the course of maybe a month or two. And we told them at that point, it's really up to them to follow up because investors spoke to you, they're expecting a follow-up from you. Now we help the client write the copy. But what happened in this case was that it was literally, hi, comma, are you interested in investing, question mark. And he copied and pasted that statement to 24 people and just click send. And that was the follow-up he got, and then didn't understand why there wasn't good feedback or there weren't enough investors that responded to that message. So I think a critical mistake, or I don't know, again, I don't want to call it a critical mistake, but like best practices is maybe what I would say.
Yeah.
Best practices is, you know, be personable, continue to follow up. You know, your whole thing of, your whole point of don't ask, don't get, following up is the same thing, right? Like one of my first jobs, even before Morgan Stanley, to get licensed, I was a cold caller, and they told us the only way you hang up the phone is if you get the deal done or they hang up on you. And I think that mentality is really what needs to be implemented when you're doing this outreach for yourself or investors.
So
I
tell
think
me,
another,
yeah, go
I'm
ahead.
sorry.
Then I was just like about to ask, so what was your longest call you had?
I mean, today I don't have those types of calls anymore in terms of like
But
outreach to
back then.
investors, but back then was different. There was no video calls. Back then was phone calls. And when I started, it was 2009 or 10. So it was right after the crisis. And I had so many people like, oh, you're just like Bernie Madoff, and slammed the phone on me because it was like right after all of that went down. So that was a lot harder. But look, I'll tell you, I was a cold caller, and to get a deal, and we were selling like Alcoa, Pfizer, Merck, stuff like that. So blue chip stocks on the market. And the job was literally like you would sell this, you would call someone out of the blue, you would make a relationship, you would call them back, you'd sell them 5,000 shares of Alcoa at, I don't know what the price was then or even what it is now. You would put the trade in, and then you would then call them back to say the trade was executed. Now give me your full address and your social security number over the phone. And we
Oh,
would close
wild.
business. They would give it to us, and we would close business that way. So I don't know if that's done anymore. I'm sure it is. I mean, I have been out of that specific role for, I mean, at this point, more years than I'm going to admit here on the phone or on the call. Um, but it was possible then. I don't see why it's not now. And we're a tenth of that, where, our firm is really calling investors to present them with an opportunity to speak with a founder who's raising capital.
So how long does it take for, usually, for early stage founder to raise the capital right now?
Ooh, that's a rough question.
I know it's like it depends, I guess, right? But
It depends. Look, I'd say that anyone listening, um, please, when you read news about a founder raising a seed fund in 30 days of $25 million, please, please, please take that with a grain of salt and actually look into that company, because more likely than not, you have a founder that spun out of Meta or X or Google that had this huge network that already had an idea or a product and was raising based on themselves as opposed to anything that they were building or anything else. But nowadays, I would allot for or time budget for about 6 to 9 months to go through a proper fundraising process, which means you get spun up, you start doing the outreach, you start building a pipeline of people that you've spoken with that have had some interest in. And then at a certain point in time, maybe 60, 90 days later, you start going hard after like, okay, now it's time to close on capital, and we need the money now, and put like start putting FOMO tactics out there. But that's what I would budget for. Look, it really depends on the business. Something that I, despite vehemently disagreeing with, but is a reality, is that seed stage investors today are looking for revenue. Again, I disagree with that notion. And for people that have been around long enough, 10 years ago, a seed round would be capped at $2 million. Like anybody raising more than that was just like, you raised a $5 million seed round. Like, holy moly, that's unheard of. And the definition was that I'm seeding a company so that it can grow and generate revenue. Fast forward, an average seed round is $3 to $5 million. Average low seed round is 3 to 5 million, upwards maybe of 10, and the expectation of revenue is there. So I think naming of rounds has been a little bit initially subjective, and now it just doesn't necessarily make sense to the titles of the rounds. But in either case, you're looking at 3 months, you'll have a really good idea of what the market looks like and what the interest is in your company. 6 months, you probably have soft circled some commitments that are dependent, perhaps on a lead, perhaps on other commitments coming in, something along those lines. And then really by 9 months, you should be able to either close or start the closing process.
okay, fair enough. And then you mentioned, okay, so the investors right now want revenue straight ahead. So how do you see this whole landscape changing? And maybe also alternative ways of raising. You had experience with crowdfunding, right? That which is becoming more and more popular for among the founders. Could
Mhm.
you a bit comment on that?
Sure. So I guess two questions. So on like seed stage and revenue and where do I see that going? I'd have to think about that more, coupled with the fact that AI exists, and I believe that costs will start to become reduced for any business in terms of both operations and in terms of like development and build. I think that perhaps maybe even the average round size comes down in some way, shape, or form because you don't need as much money to do the things that you used to have to do. That is a hypothesis that I'm not standing by that, so please nobody quote me on it. But I think that's probably what's going to occur. And I think that, that's what I think is going to occur with AI and how things are progressing. Less money is needed to build a product, at least to get it to MVP or beta or launch or even revenue generation for $1 or $2. So you'll have founders be able to more quickly get to that point of being able to raise a seed round, whatever amount they're looking to raise is. And what was your second question?
Another one, alternatives for fundraising, right? You have experience with the
Crowdfunding.
crowdfunding. So what are your thoughts on that? And maybe founders can start jumping through different rounds and then aim for the bigger one after they generate more revenue and grow faster. I don't know.
So yeah, I'll answer that backwards. I'm a big fan of that. More rounds at lesser amounts. So raise what you need, maybe a little bit, not maybe less than double what you need, and just raise more often to a certain point. I always talk about like the Warby Parker example. They raised really up until their IPO. I think they IPO'd at $1 billion or $2 billion. Right a couple months before they did that, they raised another round of capital just to bump their valuation a bit higher pre-IPO. And keep in mind that every time you raise, hopefully it is progressive and you continue increasing valuation. As long as it is acceptable valuation that you're raising at, you're benefiting the investors that have come in prior each time you do that, and they see growth in their own portfolio. Crowdfunding is something that is, anyone who is looking into it should just know all the facts about what they're doing. I think it is a great source for raising capital, dependent on both what your business does and industry that you're in. Usually I see like CPG companies, for example, do better in raising crowd funds than others. But I've seen all different types of companies raise capital. The items that people need to be aware of is depending on what regulation you raise crowdfunding under, a lot of people have called this a mini IPO for a variety of reasons. And the main reasons to be aware of if you're doing a Reg A, Reg A Plus, or any one of those is that number one, there are registration requirements versus a Reg D, where you have to submit a form. With a Reg A, you actually have to register as a security. There are financial reporting and auditing requirements that cost money, both internal operations as well as hiring a firm to do an audit. And then there's also marketing dollars that need to be spent. And what I mean by that is if you go into any of these crowdfunding platforms, usually in your sign up, you'll have like a diligence file that needs to be put together by a third party. You'll pay for that. But I'm talking about marketing. So when you do this type of Reg A or A plus or crowdfunding, most of the time, a lot of these platforms want you to participate and bring the first dollars in, however you do that. So what they'll say is that, okay, we'll list you on our platform, we'll do diligence, as long as you're approved and maybe you pay a listing fee, we'll get your company up and set up and people can invest. But only when you raise $50,000 on your own will we put you in our newsletter. And oh, by the way, when you raise $100,000, we have a special newsletter that we put out to all of our investors of rising star companies that we'll put out. And oh, by the way, when you get $150,000 in, then we put you on our front page on the home page. So all the meanwhile, what's happening is you're spending money on Facebook ads, on Google ads, you're spending money on targeting or retargeting, you're spending money on essentially like leads that are investor leads coming into the page and investing $1,000 or $5,000 at a time. So I think what people need to be aware of is the initial cost of the marketing that's required for a crowdfunding raise. A lot of numbers that I've heard thrown around is somewhere between $100,000 and $200,000. And number two are the ongoing expenses that need to be incurred from a reporting and registration requirement for those companies. I'm not saying that any of these things in a negative way, but rather things to be aware of. We have a client right now that raised several hundred million. We have two clients actually that have raised several $100 million through crowdfunding. One is an infrastructure company, so nothing to do with CPG. It's transportation. And another one was a real estate investment firm whose main form of raising capital was social media.
Yeah.
And really like hundreds of millions of dollars that they were able to raise.
Yeah, that's why. But crowdfunding really relies a lot on the media part, and
Yes,
you have to play it well.
exactly.
But it could be a very good source of income. So, talking about the startup ecosystem and looking ahead, what are some trends and emerging opportunities you are excited about? Are there any?
I'm a big fan of just personally investing in infrastructure around whatever is the hot topic of the year, of the past year, of the next year, whatever the case may be. So AI, big fan of AI, and I'm learning more and more in terms of how that is being implemented, both into my life, into my business as an augment to people, as well as kind of a replacement of others. You mentioned Lovable earlier on this recording. It is something that we recently used to launch an internal product. So I think that my point is around AI, if I'm saying infrastructure, then what is the infrastructure of AI? When we look at AI in general, what does it depend on? I believe AI will continue to grow. But if AI continues to grow, what also needs to grow fundamentally as that? So instead of making a bet on Anthropic, on Perplexity, on GPT or OpenAI, or on Google Gemini, on Google or whatever, making a bet on any one of those, I'd rather think to myself, okay, well, what is powering AI growth, right? Like processing speed, servers, data centers. We have two clients. One is a venture fund specifically focused on quantum physics, and another client who is working on data communication efficiency, like free space optical connections.
Mhm.
Those types of technologies are not only needed for the advancements of AI, but they are currently in development. And when you think about AI, again, I'm just sticking to AI for now for a moment, is that every single day, the amount of data that is just thrown off by this world, by any person, is increasing. Every car has sensors now 100 times more than before. I mean, I wear an Aura ring, so it's collecting my data. We have phones with gyroscopes in them. We have laptops. We have programs on the laptops. We have all of this data, right? And for a while, we didn't have the ability to process the data, let alone do anything with the data. AI kind of solves the processing capability and speed of doing that, but it is throttled by the processing power that occurs. And that is throttled by is the bridge of interconnecting data, raw data, and the actual processors. So when you think about AI and its growth and its digestion of information and processing, again, very, very much a fan of and believe in the progression of AI. But I think that's more so the case if I were building a thesis on my own of investment, of why data centers, of why free space optical, of why quantum computing really makes sense to invest in, because that is almost like, I'll quote Gretzky, although soon we'll probably be quoting Ovechkin, but skate to where the puck is going, not where it is. And this is the same advice that I would give any founder. If you're building a solution for today that's going to take you 3 or 6 months to build, then you're building the wrong solution. You should be building a solution that's going to take you a year to build into the future, because at some point you'll catch the curve and you'll actually build the product to when it's going to be most desired. And that's
Fair
the same
enough.
thing we did internally. Like 6 months ago or 12 months ago, I tried doing the same thing through GPT or through Lovable, and I was not able to.
Hmm.
3 days ago, I did all of that in a day. Well, all of it. I did 80% of it in a day.
Yeah. That's wild, actually. I had similar experience with some things I'm building to automate some of the things I do, and that was exactly the same realization moment in comparison, like just few months back. 3 months ago, I tried to optimize and to do some integrations. It did not work smoothly, and I had to really dig more. And now this week, I was just like, what if I try it? And it just worked,
And it
which
just
is,
worked. Yeah. I
yeah,
mean, and now imagine another 6 months or in another year, what that's
exactly.
going to look like.
Yeah.
It's really impressive and incredible. And again, going back to my point, like you're paying on credits for Lovable, you're paying on credits for GPT, you're paying for credits, you're paying for data, you're paying for processing, and you're actually like someone somewhere is physically this data is being processed on a server in the cloud, which is a physical space anyway, over connectors, over free space optical, over copper wires, over fiber. Like all of these things must exist for us to process more data.
Yeah.
So anyway, that's a big belief of mine. I mean, a side piece of that, I'm sure people want to hear about, like not necessarily like the standard pieces, but look, it's true. Like AI is going to affect a lot, or at least like computer vision and learning things from We have a client who has created a platform where you scan your body type. They're partnered with a number of clothing retailers now and clothing brands. And based on your body scan, it will not only virtual fitting room, which has been around a while, but it will fit you specific to brand clothing within centimeters. So that I can buy a large on Zara or a medium on Ralph Lauren, and both will fit me perfectly because, or maybe neither, but both will fit me perfectly because of kind of how that app between vision and AI now has connectivity and fitting us together.
Yeah, I think
So
that's
I think AI is what everyone has been talking about, but I think it's more, you know, I don't want to say that I'm investing or we're only looking at AI companies, but I do see its benefit to almost all the clients that we have been working with and how it is augmenting their business to progress forward faster.
So, for someone who is listening right now, for us, I do have this tradition on the podcast to leave the audience with a question to ponder on. What would be your question for people after this episode they can think about? And mainly, I do believe today we have quite a lot of people who are building something or about to start to build something.
I think something that I learned recently, I mean, look, I've been doing specifically what I'm doing now already for or only for 10 years, right? Depending on perspective and how you look at it. If I'm looking at it now, looking back, it feels like, oh my God, it's already been 10 years. I'm sure in another, 20 years, I'll look back and say, oh, that was only 10 years into it. So perspective is relative. So the question I think, especially to your point of there are a lot of people either thinking about building something or are building something, there are always quick wins that are capable and there's nothing wrong with that. And you could keep doing it over and over again, or you could do it once and it's more than enough for you. And that's absolutely like fine and good. And yes, please do that to the extent that everyone can do that. But I think a fundamental question that I often overlooked was, am I building something that will make the whole business better, and because of that, I will benefit? Meaning, and what I'm building to, and is the business that I'm building going into an industry that is broken, and my business is just going to add to that chaos? Or am I building something that is going into an industry or into a specific sector of an industry that is broken, and because of my existence, that whole sector will have to conform. And by nature of that happening, I will benefit, but so will the entire sector. So I know it's kind of a very philosophical question, but I'd rather people think about it more. And the example I'll give you is again, not to give myself a plug, but this is what gave me the realization is that we recently launched this platform called Fundex. And the idea is that I mentioned before, there's misalignment of brokers and advisors and firms and companies raising capital or funds raising capital in terms of like economics and even status and process. And I cannot tell you how many times, and I'm sure half the people listening on this call have had a bad experience with an advisor or broker. How many times I walk into a call and have a black eye for a fight I was not in. And I have to start defending myself saying, no, this is our process. This is why we do the things we do, as opposed to just going into it. And I recognized in building this platform, all of a sudden I had this like aha moment that, oh my goodness, if all of the brokers and advisors specifically working with early stage companies and funds did their job the way that we do our job, every single one of their clients would benefit. No one would walk into a conversation with a black eye for a fight they were not in. And the industry overall will have a better reputation. Because at the end of the day, what I'm telling our clients is that I will get you up to bat. It is your job to hit the ball. And all too often, advisors sell their clients that they will go to bat. They will hit the ball for their clients. And then they end up most of the time, unfortunately, not even going up to the plate, let alone hitting the ball. And then there's disappointment and misset expectations across the board. So again, that's my example of kind of how I came to that realization of saying, you know what, if everyone just did this process of outsourced IR, of I'm going to create the outreach and work together with our clients to do the outreach, because investors want to have direct conversations with the founders and not brokers who don't know everything about the business. Again, specifically early stage or emerging managers. If everyone did it our way, everyone would be better off for it. economically and the industry overall. And I had that realization, and that's what galvanized us to continue building the platform. So I would say to people, again, to reiterate my question, does what you're building lead to a better segment of the industry that you're entering? And if the answer is yes, then you should be more galvanized in doing it and even more emboldened to go out against competition and to customers and clients and create a differentiator of why you are different than everybody else.
Beautiful. I think it's a really great way to end the episode. And Jeffrey, thank you so much for, I would say, guiding today through this whole fundraising journey, through your background and insights, the way you see this whole ecosystem. And I can definitely sense a lot of courage to be bold, to break through the norms, but through empathetic and human approach and human way being. So I guess for everyone who are here with us today, also I would wish, yeah, let's be human, communicate, know why you're doing things, and yeah, and if you have your why, just go for it.
That's
And
right.
Jeffrey, thank you so much for being with us today. And ladies and gentlemen, today we had Jeffrey Fidelman who shared with us, so how can we fundraise nowadays and what's happening in the market. Thank you very much and see you next week.
Thank you, Zivi.
Thank you, Jeffrey. Amazing. I like how philosophical. I'm going to stop.